When investing, returns alone do not tell the full story. Taxation plays a crucial role in determining the investor's final outcome. In India, different investment assets are taxed at different rates based on their structure and holding period. Let's start with our favorite, equity shares. Listed equity shares are taxed as short-term capital gains at 20% if held for up to 1 year. If held for more than 1 year, long-term capital gains in excess of 1.25 lakhs are taxed at 12.5%. Unlisted equity shares are taxed at the investor's income tax slab rates if held for up to 2 years. If held for more than 2 years, the long-term capital gains are taxed at 12.5%. The 1.25 lakh exemption clause does not apply here. Dividends from equity shares are taxed at the investor's income tax slab under the head income from other sources. Mutual funds. Equity mutual funds, arbitrage funds and aggressive hybrid funds which invest at least 65% into equities are taxed as short-term capital gains if held for up to 1 year at 20%. If held for more than 1 year, the long-term capital gains in excess of 1.25 lakhs are taxed at 12.5%. Debt mutual funds, conservative hybrid funds and other funds which have an equity exposure of less than 35% are taxed at the investor's income tax slab regardless of the holding period. Funds with more than 35% but less than 65% equity exposure, such as hybrid funds, are taxed at the investor's income tax slab rates if held for up to 24 months. If held for more than 24 months, the capital gains will be taxed at 12.5%. Exchange traded funds. Equity ETFs, which invest a minimum of 65% into domestic equity, are taxed as equity investments. Short-term capital gains are taxed at 20% if held for up to 1 year. If held for more than 1 year, long-term capital gains in excess of 1.25 lakhs are taxed at 12.5%. Debt ETFs are taxed at the investor's income tax slab rate regardless of the holding period. Gold and silver ETFs are taxed differently. Short-term capital gains are taxed at the investor's income tax slab if held for up to 1 year. If held for more than 1 year, the long-term capital gains in excess of 1.25 lakhs are taxed at 12.5%. Debt ETFs are taxed at the investor's income tax slab regardless of the holding period. REITs and InvITs. Returns from REITs and InvITs come from two sources, periodic distributions and capital gains. The periodic distribution contains interest income, dividend income and capital repayment. Dividend income and interest income are taxed at the investor's income tax slab rates under the head income from other sources. Capital repayment is considered as return of capital and it reduces the cost of acquisition. Capital gains from REITs and InvITs are taxed similar to equity investments. Short-term capital gains are taxed at 20% if held for less than 1 year. If held for more than 1 year, long-term capital gains in excess of 1.25 lakhs are taxed at 12.5%. Bonds. The returns from bonds comprises of two parts, interest income and capital gains. Interest income is taxed at the investor's income tax slab rate under the head income from other sources, and capital gains is taxed differently. Short-term capital gains, if held for up to 12 months, is taxed at the investor's income tax slab rates. If the bond is held for more than 12 months, the capital gains are taxed at 12.5%. Two investments can deliver the same return, but very different outcomes after tax. Knowing how each asset is taxed helps investors make better decisions. This is only a high-level overview, and investors must consult a chartered accountant or a tax advisor for advice specific to their situation.